Hello and welcome to today's webinar. It's on our commercialisation of innovation series, and this one is about trade sale. Trade sale is one of the 4 significant cash generating transactions that we do, and it's designed to get you from where you are to generating revenue, which can then pay forward to get you more revenue and more revenue. We don't try and make you profitable, we just try and get you rolling, and that's the most important part of commercialising into intellectual property, particularly between our main key areas, which are post ideation and pre-scale. So we work in that area. It's called early stage commercialisation, and I want to share some points with you today on how we trade sale that when we need to. So let me share my screen and we'll jump into this. There, you should be seeing my masterclass with Tony O'Connor, Selling Your Innovation. So I'm hoping that's what you see, and we'll just continue to do this. So after this presentation, I'm hoping that you'll understand when and how to sell a project if you need to, and how to target the entities who need your project more than anyone else, because they're going to pay the most for it, of course, and also how to craft a winning pitch, and how to do it without cash, and how to get it done in 3 to 6 months. We'll also show you how you can resell this several times. You don't have to trade sell something once, because we have geographic and demographic. Jump into this and I'll show you just how we do. So the first part of this is what we've covered today. So if I can just go through that quickly. First, I'm going to cover why people would sell their ideas. That's an important aspect of this, because selling your idea, you tend to get less money for it because you haven't got any realised any cash flow. And if everything's valued on cash flow, you're going to get next to nothing. So we have to avoid that, of course. I also want to go through the factors that will increase the value for you when you go to sell it. Also how to use this process and how this process will really work for you if you're in early stage commercialisation, or you have a new idea, a concept that goes forward that you don't particularly want to carry it forward yourself. We'll look at the cashless transaction and how we can make that. So when we engineer the trade sale, you'll actually get cash, but they don't have to find the cash to get to you. And then I'll give you a relevant case study, and we'll work through that case study for a bit and I've got to tell you that the few slides around that are very heavy in data, and I don't apologise for that. I want to just compress this and give it to you in point by point, and I'll do quick explanations of some of those. Some of them, like for instance, when we talk about leverages, I won't actually cover them. I'll just show you what they are, and because next month we're going to be covering leverages, so you tune in for that, you'll be able to see just how leverages work. So that relevant case study netted 8 figures, probably closer to 9 figures. And my question at the end of this, could it work for your project? I'm going to show you if it can, and if it can, I'm going to give you a few minutes on what I can do for you, and then let you free, and we'll jump right into the Q&A. So the Q&A is with current member John. John's at the moment sitting in the Seychelles. He's on holidays, and he's going to be ringing in later in the call. So he'll actually be on a phone, so we won't be able to see him, but that's because he's sitting on a beach in the Seychelles and he can't get the internet to work. So he's going to be doing it via dial-in, so which you can do onto Zoom. So there you go. Technology beats us every time. So that's what we're going to cover today, and we're going to cover it all in about 55 minutes. So we'll just see how we go with that. So let's jump in. Those of you who stay on with me, you'll actually be able to. I'll organise to send you out a book once if you're going to get on board with me, you get a free book. Okay, I'm not going to talk too much about me. I started my journey in 1983. I commercialised a product called telephone accounting system. If in the 1980s you checked out of a hotel and you got a bill for all the calls you made, and it was all fully costed, it told you when you started the call, when you finished it, who you called, etc. That software was called the telephone accounting system. We developed that and sold it to the people who bought private branch exchanges from the big companies. They just recommend they go to us, and we put it all in and set it up. Later on, we trade sale that to one of the big Japanese multinational. So we've been through this process before. That was my first one. My latest one is the cornerstone investor model, which if you've gone through the investment significant cash generating transaction, funding was one of our early ones, then you'll have known all about how the cornerstone investor model works. But we use a lot of it in all of our significant cash generating transactions. So these are some of the companies I've worked with and still do. Others out there who really you won't know because they're all small R&D companies or small individuals. It's pointless putting up names. So what I want to do is go through now why inventors sell ideas in the first place. It's not something you want to aspire to unless you've got reasons. And those reasons might be that it doesn't fit your current business model. That's fine. If you're building a portfolio of intellectual property and this doesn't fit, get rid of it. Focus, keep yourself concentrated. I'm too busy to give it the attention it needs. That's always, if time is important to you and you don't have enough for that particular project, then by all means, if you can't outsource it at the right price, then it's time to move it on and get a price for it. It needs resources and skills you don't have. That can always drag you. And if you don't have those skills or resources to get those skills or other monies or whatever the resource is, you can get into some serious trouble. And when a project stalls, it's losing. It's costing you money. You might have something better. It might be a better fit. It might be a better source of income. It might be an easier project to get over the line. It might be a higher yield. Either way, there's a reason for bigger, brighter, and better. And you might decide I can't do two, which is a smart thing to do. And I'll put all my efforts into the one project, which happens to be the other project, and therefore I want to get a price for this. I need some money for my current business. Sometimes when individuals who manage a business or own a business create an intellectual property and they start nurturing it, they find that it's going to start eating more and more of their funds. So then they go backwards and say, okay, well, let's just focus on our business. Let's put that on the shelf, or let's find a buyer for it. It needs far more money than what I can get, is a very common one that we get, where people recognize that they won't be able to supply what this thing needs. Now, in the case of universities, they sell their IP very early. The whole idea is if an intellectual property, an idea becomes a concept and then becomes a project, it now has value. That value might be, once you start earning money, the value might be, let's say, $500, but today it might only be worth $100. Well, they're prepared to sell it for $50 on the basis that the company that buys it contracts back into them to finish it. So they might still get $350 for their $50 because they've got to do the other work, but this time they're being paid to do the other work rather than just speculating. And the big advantage they have is most of the companies that buy their intellectual property contract back into them and get a grant to cover half the costs of what they're paying the university. So it's a win-win for everybody. So that model will not work for small individual inventors or small R&D teams. If you're not part of the university, you're not going to get that. Okay, now I want to talk about the path to market as you may understand it, and the path to market as we put forward. So if I start with what we think you would firmly believe in your early days, we start with an idea. Now that idea, you're encouraged to get a patent. Once you get a patent, you're encouraged to go and get funding. And that's the most people stall in that area there. And the reason why they stall their project is because they don't know how to raise funding and they don't have an asset to raise funding against, because the patent is actually not an asset, it's a liability because you've got more money coming out that's got to pay for it. You still don't know what value it is. After funding, you then go to scale, or you license the project. So scaling is where we take it and we are able to 10x the project simply by putting a bit more asset into it, a bit more effort, and we grow that business to 10 times what it was. Or we may go out and find a licensee who would take it on. When we do that, we still have to exit this. And what we do is 3 of the major exits are a public offer, initial public offer. So we might actually, if the company's grown large enough, we might say, well, let's list it on stock exchange, or we may find a company that's listing that has a lot of very steady income but don't have any blue sky, and this is the blue sky they can punch in. So existing shareholders will want to buy more shares, and therefore when they launch onto the stock exchange, they're much better. They've got a bit of momentum. There's other exits such as trade sale and the likes, but of course, if you don't have income, you don't have a trade sale. So that's how most people see it, and that's how it's presented to you from people like accounting firms, patent attorneys, the likes. They say it's easy. Give me the patent, and I'll show you what you do for those next 2 steps. It's not enough. Here's how it really works. Firstly, yes, you start with the idea. The idea isn't worth any money. We've got to build value around it. And the way we do that is to build you a commercial model. A commercial model has a lot of elements to it, but the key ones are a proof of concept, market validation. We also have to calculate the pricing, costing, and sourcing of that project, because we have to know that there's enough margin in it, in between pricing and sourcing, to know that, pricing and costing, to have a dollar in it for you, but also for every other level of the commercial model, because it might be a channel, and it might need distributors and retailers. So you've got to build all those margins in. So to give you an idea, a consumer product might have 7 times the cost in retail value. So you have to have all those margins built into it. So a 700% up or 600% increase. Okay, so the commercial model, once we've done that, yes, also risks and revenues. We have to work out what are the risks and how we're going to contain them, and also what are the revenue streams. We have lots of options. We've got to work out which one's going to give you the most and how it's going to deliver it and over what time, so you can do projections. So once you've done all of that, and there's lots more to do in a commercial model. In fact, our commercial models usually have about 500 data points, and we've printed on a mind map, so it's huge. Now, once you've done that, you can then start stepping into the patenting process. And what we try and do is get you a provisional patent after this point. So everyone who's looked at your project or collaborated with you on that project have signed a non-disclosure agreement and a waiver of rights agreement. So everything that's built into that commercial model is owned by you when you patent it. You only take a provisional patent. That gives you 12 months to get it commercial, so then the project can pay for the patent conversion, not you. So once we go forward on that, we have to have a clear path to market. Now, a lot of people think the path to market means, yes, I have to go and find myself an end result. And that, for us, is not very profitable. It's pre-scale. So pre-scale is where mostly venture capital firms, private equity funds, or larger corporations will look at your project and recognise that if they put 10 times the equity in, they're going to get 100 times the output. So they're willing to share that with you. So in which case you've got a project. In order to get there, you have to be able to generate income and show a high growth trajectory. So how do we do that? With these 4 methods: funding, distribution, licensing, and trade sale. Each of those 4 is a cash generating transaction and should be a significant one. So what we're looking at today is trade sale. And we're taking it all the way to an exit. So we're not going to pre-scale. Trade sale can be a straight exit. And so in this case, that's what we're going to promote. So I'm going to show you how we did this with the last project, with that project, the case study we're doing today. Okay, so the 12-point pitch, for those of you who've been in the last 5 of the series, you will know that I always talk about the 12-point pitch, because the 12-point pitch and leverages are featured in every one of our presentations. So it's the same 12 points, whether you're funding the project, whether you're setting up a distribution agreement, setting up a licensing agreement, or selling the project, you still do the same 12-point pitch. There's a few tweaks on it for each of them, but there's not significant differences. So it's almost the same 12 slides. We do it in 30 minutes. We don't have any massive bullet points on the screen like I've got today, and that I've apologised for, but you would really have talking points which you then talk to, and you could get it all done in 30 minutes. Having a patent for a trade sale is an advantage, but a provisional is okay. In fact, in a lot of ways, provisional is better, because what it does is it allows you to sell into territories that you haven't converted, because you've targeted maybe one territory, but your provisional is global. So you can now, if you can bite off 10 different territories or regions or jurisdictions to sell this into, you can actually make more money from. So the more you can do, under a provisional, the more coverage you can offer them to convert their own pay. Okay, so you have to know your costs going forward, and that's why you're selling it. But chances are if it's a business from the same industry or the market, they will know their costs going forward, and so they'll be able to contain those costs and they'll be able to cater for them. We're going to show you how we do leverages when we do our 12-point pitch. We show them what the leverages are, how that's costed, and how that reduces their buy price to nothing. We also introduced a cashless transaction. So if that's available, it's only available to you if you're trade selling this to a public listed company, and I'll show you why later. You will offer to share their future, and we do that through options or delayed shares. And the reason for that is because you might set some KPIs. They might offer you $100 for your product, and you say, I think it's worth 300, and you agree on 200 based on 100 upfront, and then so much over every 6 months for the next 2 years based on key performance indicators. If you can do that, you've got to double the price. So we don't usually double, we usually do 50, 25, 25, 25. So it's 125% of the price. After that, you've got to have ready your due diligence file, and you also then prepare for them. So our last slide in our series is on our 12-point pitch is where to from here. And one of the elements of that is, here's our program going forward we're going to give to you. Here's our due diligence. In 7 days, we're going to come back to you. We're going to ask you for your questions. And if you give those to us in writing, we'll actually present our answers to you. And also, we're going to provide you with elements of an agreement we would like to see, the features that we'd like to see in an agreement. So what happens is, you're not saying to them, here's our contract signed here, because that gets people up. And most importantly, it makes them send it to legal. If it goes to legal, you've lost 6 months. So you've got to be fairly careful on that. So the way we do that is we provide elements of an agreement. We tell them in advance, we're going to provide you with a list of elements of we'd like to see in an agreement. We'd like you to do the same back to us, and we'll formulate something from there. So that way they've contributed. They've seen there might be some things in yours that they will never accept, and vice versa, in which case you need to know up front, and you have to negotiate around that. So I try and do that informally as possible and without any sort of obligation to them, but rather we invite you to give us back your elements of an agreement, or elements you'd like to see in an agreement for this. So it makes it far more attractive for them. Okay, so going forward from there, I want to show you how we compare a standard pitch to our value pitch. So I'll just charge through. This is what people's pitches generally is. This is the theme of them. You can make money out of this. Buy our invention, you'll make more money. We've got a patent, and it's going to be protect you. You can do what you like with it. If the market is worth $10 billion and you've got 1% of the market because of us, then you're going to be worth this. And that's the basis of their marketing in a lot of cases. Here's our price and here's our terms. So let's get into this. Here's my non-disclosure agreement. When you sign that, I'll show you what we've got in detail. Meanwhile, we can talk in generalities. Here's my consulting rate. If you buy this, you'll need me to help you, and I'm available, and here's my hourly rate, etc. So they're already selling their services in the pitch. And I've got lots of people looking at this, so you need to make up your mind. There's urgency on this. Pressure, pressure, pressure. The way we do it is without pressure. Here's a product. It'll add value to your current buyers because it complements the current products you've got. And we list their products and show how they complement. And we also talk about their buyers, because if you've done your research, you know that. If they're from your industry or your market, you doubly know it because you've been immersed in it. From there, every sale you make, you increase your average sale value. That's important because average sale value is, if I'm selling my current product, which is a hamburger, for $8, I add price to that, I'm getting $11 or $12, but my marketing cost is $0 extra. So I make more money on the fries than I make on the burger. It's that simple. There's no marketing costs. And there's no lag, so they don't have to develop a market, create a channel, start building the product and sampling it, testing it. Everything just fits straight into their existing production line and their existing distribution point. So same channel saves a lot of time and, or most importantly, a lot of money. Here's our cashless transaction. proposal. I'm going to talk about that a little bit later on. So I'm not ignoring it. I'm not going to explain it now. I'm willing to share your risk. So I'm going to have KPI-based terms for the back end of this deal. So you don't have any risks. I'm going to wear the risk because I know I have confidence in my product and I want this much at the settlement, but the rest can all come from KPIs, and we'll agree on those KPIs. Then here's your other leverages and risks. I talk about their risks so they understand, not because they don't know what their risks are, it's because they now know that I understand exactly what their risks are. So that's the only reason you give our risks. And our leverages is how we discount their sale price back to zero. And I'll show you that in another, later on in this presentation. And here's where we go to from here. So I have that where to from here. That in itself is a very important part of, so it sets the agenda. Otherwise, even if you get a yes, your next meeting will be unproductive if you don't have an agenda. And the reason for that is everybody at that meeting is going to be clapping each other on the back saying, we did a really good deal here. This is really good. We don't want to get into the awkwardness of consummating the deal. Let's just talk about stay in that happy place of, yeah, we've agreed to it. And you need to push them past that awkwardness and into getting this rolling. It's in your interest to do it. It's in their interest to do it. So what do we have? With the cashless transaction model, we're trying to give them an opportunity to get this product for nothing. That would be important. It would be an easy sell if you could do it for nothing. And how we do that is, firstly, we find out what the true value is to them. So once we know that, how would you like to pay nothing? So let's say our price is $100. We're selling it for $100 million, doesn't matter. Our price is $100. Now, how would you like to pay nothing? Sounds like a pretty good deal. What if you pay in equity in your company instead of cash? So that might mean you do a rights issue to our company and we give you shares for shares, script for script rollover. We provide 100% of our shares in exchange for a number of shares that equates to the price we've agreed, which is $100. So if that were the case, you've got no cash going out. You don't have to take from your existing year or future year's budgets. It's all just done. And we're part of your team. And it's an easy sell because you do. It requires two things, a rights issue, and it also requires either a circular resolution to shareholders to get permission to do it, or you get a vote at the AGM. Whichever way, it gets done. So you fund the project going forward. That is, they would fund the project going forward because it's going to cost them a whole lot less because they're in that business or that industry. They already have the channels. You're picking them because it would cost them less to go and do this. So it's part of their regular business. They already have their overhead. Sometimes, like the one I'm going to show you today, was a full book. But sometimes when you walk into a company, they're running at 60, 65% production. And you say, I can get you to 90% production by adding our product to your, adding another line to your production fee. Your overheads are not going to, your fixed costs aren't going up. Your variable costs might. And guess what? You've got a whole new product line to the same customers. Big, easy sell, that one. I think it's worth more than what you want to offer us. So $100 isn't really great value for me, but here's why I think it is. And if I prove it to you, will you reward me risk-free? So if I take away the risk for you, will you give me the reward? How do we do that? It's pretty easy, really. We start with a 50% settlement, then we get 25, 25, and 25 per 6 months over the next 18 months. If you're prepared to do that, and we put KPIs on those last 3 payments, let's get this done. Because I'm saying to you, I'm prepared to wear some of that risk. So I want you to give me 125% of what you really want to pay for it. And it's going to cost you next to nothing. So some people even take options on this. They scale up the options. So they get, instead of thousands of options, they get millions of options. And that the asking price is today's price, the conversion price. So then I'm saying the KPIs are the share price has got to go up, otherwise nothing. And then I still buy my shares, but I buy them at today's rate. And in 3 years' time, they might be worth, twice that if the company's done the right thing. So who knows? But that's how we would do it with shares or with options. Now, issuing capital through a rights issue requires, as I mentioned, circular resolution to shareholders, sometimes a vote at the AGM. You've got to be careful with a vote at the AGM when the AGM is, because if you have done your research, you know if they're a calendar year or financial year company, and they're usually 9 months after that, or 8 months after that, they have to have held their AGM. So they would be geared up for their AGM at that round about the 8th month, 7th or 8th month. 6th or 7th month, they will be sending out the AGM invite, and any resolution that's going to be at that meeting needs to be on that AGM, the invitation to attend the AGM. So if that were the case, you have to have it all done and dusted by then. So if the timing isn't right, then ask them to do a circular resolution to shareholders, or if the meeting's coming up and you're too late to get into the AGM invite, ask can it be a special resolution on the meeting, and that can be tabled. But in order to do a special resolution, they still must send out something to the customers, to the shareholders, because the shareholders don't want to be ambushed by something that sounds great, but they haven't seen any data. They're not going to make any decision. They're going to vote it down every time. So you have to be fairly careful about that. Okay, our case study today, John, I hope he's on the line. I can't see because I've only got my screen in front of me at the moment, but we'll talk to him at the end of this. John started out, spent most of his career as the Australian manager of Hitachi trucks, which make the big haul pack trucks for mining. And he was the country manager for Australia, and he had a pretty good crew. He had a good access to all the big mining companies. He did very well. As part of his role, he travelled around the world, and when he was in Chile, South America, he found this particular type of high tensile steel, very large tip body. So it's called a tip body. It's basically the dump part of the dump truck. And these went up to 425 tonnes. So big, massive beasts. So they're mostly used in coal and iron ore. And the laser cut from high tensile steel, they're transported in 3 pieces because they're too big to go on the road. So they split down the middle, and then they're welded up on site. That's how big they are. And they also do the front. You can see the cabin guard and all the edges. They all get welded on afterwards. So what John did is he got a license from the people in Chile because they only had a patent in Chile and North America, USA. They didn't have a patent in Australia. So he said, well, I can't buy a license from you because you can't protect me. But what I will do is, why don't you give me the license? I'll pay you $1 and we'll just call it a license agreement. And they did. Now, he didn't actually pay for that in the end, but he got a license agreement for 18 years, which is the life of the patent to run. And so he had that in Australia and he was ready to go. He set up a fully automated plant. It was a full production line. He had early failure issues, which he set about resolving. So he spent a lot of money looking after his clients, and they recognised that and they rewarded it. And as a result, it became a very good product, and they started ordering big. So, but he got to a point where it was just production, and he wanted to retire again. So he's looking at how to do that, and he was going to publicly list it. It wasn't attractive on its own. So what we did is we looked for a public listed company to trade sale it to. So let me go through how we did that. Firstly, the company, DT High-Load, he offered them a white label product. Basically, they could call it what they liked afterwards. They chose to leave it. Here it is, 12 years later, 6 years after the sale, it's still called DT High-Load. So he, as I mentioned, he started after retiring. He built the business over 6 or 7 years, and he wanted to retire again. He wanted that trade sale option as the easiest option. He'd already grown out the business. Now he wanted to trade sale it. He wanted an outright, not a staged sale. He just wanted to walk away. And he had 6.5 years of forward orders on his books. Now that's phenomenal for a company. The mining companies had trusted him so much, they'd given him 6.5 years of forward orders to buy the fleet as he was producing it. So every bit of inventory in his factory was pre-sold to somebody. He was selling, when we put the deal up, he was selling cash flow with a license he got for Australia, the territory of Australia, from the owners in Chile, who owners of the intellectual property, who granted him a right for $0. So what we did is we framed the deal in a certain way. As you can see there, the split down the middle without the edges and the cap cover on this, where that's 1 piece, that's 2 pieces. The third piece is a massive amount of gear that goes on top. But that's just getting things. So if I run through this framing of how we framed the deal for him, we said let's retain the premises and lease it to these people, so that way they don't have to include that in the price. If there's a public listed company and they're in mining supplies or mining engineering or something like this for fleet management, they are not likely to be able to hold real estate in the company's name because the public companies can't diversify too much. So if that were the case, let's not burden them with a few $1 million worth of property, but rather just they sign a lease. It's a lot cleaner to do that. And John didn't mind the idea of doing nothing to recoup his investment there and have them pay it off. So we decided it would only be a public company because he wanted equity, because that was the quick and easy way to do this. For cash, it was big enough that somebody would have to take a year or two, a budget cycle or two, to be able to afford to buy it. He didn't want to sell half and then work them into it and then they buy out the other half. He wanted it clean. We did our 10-4-1, which is something we do. A 10-4-1 is where we work out who our top 10 were. And from him, it was from customers and competitors. The 4 ended up just being 2. And we calculated based on those 2 to get the best pitch. We had another little side curveball being thrown in here. And that was John, after he got to 5 years, you can see those little spots in the middle of the tray. They're called wear plates. And the reason why is because they can sometimes, with iron ore in particular, they can have boulders or rocks of 60 tonne dropped on them into the pan by the loaders. Now, if a 60-tonne boulder drops into a tray, if it's a low tensile steel, it'll bend it. But if a high tensile steel, it'll actually crack it and put a hole in it. So they've had to put these plates in. That was one of the things he had to do that the Chileans never did, to make sure that he could get the wear and tear that they needed. So that was quite unique to Australia. He was able to do that, and as a result, they needed to be replaced, and the whole thing's needed a bit of an upgrade after 5 years. So there was a refurbishment contract being offered to him. Now, he did not want to take that refurbishment contract because his factory was full and he had to buy and build another factory to do it, and he was being offered it. So what he did, very cleverly, he said, send me an offer. And he did that. He rang the 2 companies, the 2 major iron ore mining companies who he was providing these to. And he said, you want your tip bodies refurbished after 5 years? That's fine, we'll do it. We think we'll do it, but we want an offer from you first. So they got the offer. He had no commitment whatsoever, but he had an offer, and it was for millions, tens of millions of dollars. So he knew he could add that to the price or to the value package that he's offering. So, and there were others that were trying to bid on that, and one of those became the buyer here. So whoever bought his project would automatically win that if he said yes to it, because they were box seat. They were already a prime contractor and they already had the knowledge on these. Nobody had to learn it. So 5 years of forward orders is a big thing. It's tens of millions of dollars. He had a fully automated production plant. He had a lot of engineers in there, but they were maintaining all the robotic welders and CNC presses and everything else. The gantry cranes for loading and unloading, they were all specialists. They weren't your normal people who just carried steel around and welded it. So he was a prime supplier. He had a contract to all the big miners. That's in iron ore and coal. I think probably at that stage, 95% of the iron ore was through 3 companies, and there was only 4 companies in the business, and he was supplying all 3. He operated to ISO 9001 already. It was all fully implemented into the plant because he needed that as part of his contract so they could audit him. But also, his daughter was who worked in the company was a quality auditor, so she just took it over and did that. He wanted to offer the businesses a walk-in, walk-out with little or no unsold stock on the floor. So that was a tremendous advantage because there was no very large stock at valuation. All stock was pretty much covered by deposits. So how did he do it? This is the secret and how he implemented that. That was the deal we framed. How he did it, we used the 10-4-1 process to qualify buyers. Instead of getting from top 10, we got our top 10. How did we get to 4? We actually only got to 2, and 2 really stood out. One of them was going to be bidding on that refurbishment contract against him, and the other one was a very large truck refurbishment company. Ironically, both of them bought it because the one that bought it actually trade sold their entire company to the second one later on. So it was a roll-up. But he was already gone by then because he cashed out because he had public listed shares. They pitched on the cash flow, the net present value of future earnings discounted for risk. There was no discount for risk because he didn't need to. They were locked in contracts. He calculated the leverages that he's offering, and the biggest one was that refurbishing, but also the forward orders. So that covered all the costs that they're going to pay for this, well and truly. And his cost for refurbishing, for dangling that refurbishing contract was pretty much nothing. So he didn't have to provide anything for that. So he was offering the plant at asset value, and he didn't do any discounts. He didn't do any depreciation. He just offered it as it was. They accepted that. He offered to lease back the premises, and that reduced their price. So going in, they didn't have to add another 10, 15 million or whatever it's going to be for that fully automated plant. They were buying everything in the plant, but the plant, the land and the building itself wasn't going to be included. All they had to do was pay rent. He didn't need to cater for any blue sky because he had the blue sky locked down under contracts. He had the script to get the appointments because he pulled that straight out of our system. The scripts to find the people, to qualify them, get the 3 levels. 3 levels are the people in charge of project management in his level, the board of directors, and then the auditors. And so we had to do scripts for all 3 of those. We got them all prepared. We also did the pitches for all 3. He did his 12-point pitch. He only did it. Normally we do a 12-point pitch for up to 4 of the 4, and we do 1 at a time because they take a lot of work, because we have to bring all those leverages to account and cost them out for relevant to that particular party, so they can see how it's going to be most relevant to them. So once we've done that, we had our due diligence file ready to go. We compiled that very early, so he was able to provide that. Once he did the pitch, they'd already signed non-disclosure. He slid that across the table and said, right, where to from here? This is how we go through due diligence and into elements of an agreement. So he was ready to go, fully organised, and they recognised that, and they were able to get on with it. Because he was an audited company with his ISO 9001, they knew the accountants. They were able to take that on and very quickly do due diligence. So how did his leverages work? Well, I'm not going to go too much into leverages. That's our next month's thing, but I will show you there was a list of 14 leverages. There's 15 there, I know, but cashless transaction is not really a leverage, but we did use it. So his on complementary products, existing channels was big. Forward orders was a big one. Access to his skilled personnel that could go to their company, and their skilled personnel could come into his, was pretty easy. Sometimes it's one way. This way it was both, so it was a lot easier. He had a 12-year exclusivity period under his license left to go before the patent, the agreement would run out, because the patent in Chile and North America would expire at 20 years. So they had 12 years left to go. White labeling, at that point, it was, that was about 6 years ago. He offered it as DT highlighted, said, call it what you like. And that other company just left the name and kept it. So, so they also could, he was expecting they would recover lost costs, because they lost sales, because they eliminate the competition, so they get every deal. So that's just some of them that we go through, and I'll go through those in far more detail next month if you attend my seminar for next month. Okay, so how did that work out? Well, firstly, he was able to get the costs. This is what you're going to pay for it. There's going to be ongoing rent. There's going to be inventories at valuation. There's going to be operating costs per annum for all the staff, wages, etc., but all the equipment maintenance, everything else. They knew what their costs were, including going out and doing the on-site welding to get the product signed off and then placed on the back of a big tipper and the likes. We also knew the purchase price. Once we calculated all those up, all we had to do is discount against those. Well, in fact, the sales outweighed that. So he was able to offset this against forward orders, pre-sales. So when you've got a price that's, let's say, $100 and you've got pre-sales of $600, it's not a hard deal. It's a very easy deal because net present value of those is still well above that. So on paper, it was a good deal. So they didn't have any problem with it. So we didn't have to negotiate price at all. Does that mean he could have asked more? Perhaps, but it's not really the way we fly this. Okay, so why did it work? Well, firstly, he grew out this business. So he had trades history before he sold it. So trade history, trade sale means he's going to get a going concern. He's going to get a lot more money for it. You used all our online case studies to see how it did. Now, 5 or 6 years ago, we had a lot of online case studies which were big corporations, and they really aren't all that helpful, and we recognise that now. So I've taken it down, and most of the ones we use today are single operators. So they're not names, you might know the products, but that's all. And the whole idea is they are more likely to, people in this program that we run are more likely to relate to those. So it showed him how to identify. We showed him the program we did, showed him how to identify his top 10, and he de-risked the pitch using leverages. He picked someone from the market or the industry. He did his commercial modelling, of course. We used our 12-point pitch framework. He accessed the procedures and the scripts to pitch that, and he based his price on their share value and said, here's the equivalent in your shares right now. This is what I want. This is how I want it, and I want it done on this date, where you do a circular resolution to shareholders and we can settle it in 90 days. And that's pretty much, this is how we go forward. And all I had to do was complete due diligence, which took a couple of weeks. Done. They came in, verified everything, the auditors did, and then signed off on it, and it was a deal. So his first pitch on this got the job done. He didn't have to do the second, and that was fine. As I mentioned, the second company bought the first company anyway, a lot further down the track. Now, he detailed his next steps, so he was ready to go. He had everything worked out. He became a shareholder who then consulted to the company. As a shareholder, he stayed on. He didn't stay on for too long, probably over a year, but not for 10 years. And then he decided to trade his shares out, and he fully retired. But he was available for consulting if they needed it. Particularly, he did consult, I know, to get in that refurbishment contract. So he walked away with a long-term lease facility, and his forward orders pretty much all paid out. So that was a pretty easy deal. And they bought the plant and equipment plus all the cash flow going forward and the rights. So off they went. Everybody was happy. Now, how we helped him is we used our 4 pillars. We give a full structure to our program, and I'm just going to do some shameless sales here and tell you a little bit about the 4 pillars of our program and how it helped him, how it helped John get what he wanted. So we gave him a full structure. We showed him the path to market in terms of this trade sale, and then we gave him help and guidance. The way we did that was, firstly, we took some online learning. We gave him our access to our online program called Inventors Masterclass. That's got it's got 25 hours of case studies. It's got checklist templates, everything he needed to learn, scripts, everything was all based in there, and all he had to do was drag and drop. He spent probably 4 to 9 hours a week watching some videos and getting to understand what was to be done. He got through it. He still did at the end of that, we did a workshop. We do that with everybody to kickstart their project. The workshops are all about ideation and commercial modelling. We want to make sure that when you've got your R&D done, you then plan out how you're going to get from here to pre-scale. We do that in fine detail. I start with 244 questions over 4 hours, and it blows out to about 500 data points on the mind map. We print that in A0 or A1, so it's massive. We get you to print it, actually. And then you put it on the wall somewhere, and we'll attack that every month under our project status review meetings. So we make sure that you can get that with a Sharpie and the highlighter and make sure you get greater clarity as you go. That's the commercial model. The next step is the implementation. You need help along the way, because if you don't get help, you might be still trying trial and error. You can't afford to do that, because you can't afford to burn any of these prime opportunities. So what we did is we helped all along the way, including evaluated the pitch and the scripts and modified different things to make sure that everything was covered and all those leverages were there and identified very closely and calculated. Once we'd done that, we set up a trace, track and measure process to make sure that he was progressing along so he would get from where he was now to the trade sale within a certain amount of time that he needed to. And at that trade sale, we would be able to get him the price he wanted. So all that help and guidance was provided along the way, and then we tracked and measured everything. That's the 4 pillars of our program. And then once he's done that, in most cases, if it's not a trade sale, his was a once-off trade sale, walk away. But in a lot of cases where it's not a complete close-off, we can come back in and you can now have money in the bank to pay for us to go and do your next round, or we can work on another one of the significant cash generating transactions while you're working on one alongside you. And we're working alongside you, so we're doubling your output for the next one.